Yo, what's going on, everyone? It's your boy Traq back with another video. In today's video, we're going to talk about trade management, and a few topics I'm going to cover is when to move your stop loss to break even, when to take partials, when to trail your stop, and etc. So without further ado, let's get right into this video. So trade management, right? To summarize this up, let's write TM. Now, what is TM? Trade management is basically how you manage your trades. Now, there's two things. One is finding a trade. Now, once you find a trade and you enter the trade, you have to maintain the position. Just as everything else in life, you have to maintain it. If you pass an FTMO count, you have to maintain it, right? And that's why there's two phases to the FTMO. There's phase one, and then there's the, make this a little nicer, phase one. And then there's phase two, because they're testing your consistency and your capability to see if you're able to maintain the account and consistently make profit. That's why there's two phases. Now, when you're entering a trade, you have to see how you're going to manage it. If something comes up, like let's say you enter a buy and then market structure is shifting against you, are you going to close in profit while you can get out? Or are you going to hold with pure luck? With pure luck and a hope and a wish and a prayer that the market is randomly going to go up. So these are all the questions that you have to ask yourself when you're in a trade. Now, I'll go over an example. So the first topic we'll go over is when I move my stop loss to break even. So I have a little bit of an unorthodox style of how I minimize my risk and when I move my stop to break even. So I have this theory, and anyone can correct me if I'm wrong on this. It's just a theory. It's not a proven fact or anything. But whenever I enter, let's assume that this is an uptrend and then the market comes down and this is my entry. So let's say I enter right over here. This is my entry point. Or to make this a bit nicer, let me do something like this. All right, so let's assume this is my entry point right over here. So once I get in, I notice that right away, if you're entering at a level of institutions or at a level where institutions are highly interested in and they're also entering there, you'll notice price action moves away from your POI quite fast, quite quickly in a volatile way. But then you'll also notice that the market will come back one last time to give it a second test, a second mitigation of that same zone, and then it will go up. So what I'm starting to realize is that after price action reaches your order block of entry, the market will create another order block either just above it or within the same vicinity of the previous order block right over here. So there will be another OB. Now the market comes back down to this point to give a second mitigation. Now this second mitigation is just a final opportunity. So we see the first opportunity, the first impulsive move up right here. This is where the banks last sold to buy. Now they're still holding sell orders from this move down, and hence they have to bring price all the way back down so they can mitigate their sell, add a one final buy position, and then take off. So it's moving quite quickly. Now the common mistake I noticed that traders make is within this move that we're seeing, right? Let's say we see something like this, and this and this is going to be the same, like same example. So we enter, right? This is just a smaller time frame. So 15-minute, and then this is the 1 hour. So on the 15-minute, you're going to get triggered, and then you see structure go your way right away. Now, once you see a quick BOS or continuous structure, whatever it may be, traders tend to move their stop loss to break even right away. Now, there's a couple problems I see with this. One, if there's an order block at the level of where you entered, then there's a high probability that price may come back down for smaller time frame confirmation to mitigate that one point and then take off without you. And that's a big mistake traders make, and I used to make this mistake unconsciously a lot of the times as well. Once I saw the continuation of structure or the break of structure, the change of character, whatever you want to call it, I'd move my stop loss to break even. And by doing that, I also ended up decreasing my win rate. Now, win rate isn't a big deal to me, but of course you don't want to be losing all the time. You still want to have some winners. So those losses, or not losses, but those break-even trades that I was catching, they could have easily been 1 to 15s, 1 to 20s, 1 to 10s, 1 to 5s. But because of the lack of trade management and the lack of understanding of how to manage your trade, it would end up to a break even. So what I do now that we understand that price usually mitigates a zone 2 times, one where you get entered, and then a second time where you get that second mitigation, then it goes up. Now, another way to understand this is to just think of confirmation. So let's assume there is a 4-hour point of interest. So let's delete all this, or to make this quicker, boom. See, I thought outside the box. All right, cool. So there's a 4-hour POI. We're on the 4-hour time frame, and the market created a 4-hour POI just over here. All right, there we go. So once price action enters, this is the first mitigation. Now, obviously, as we know, we don't enter right away. We always wait for confirmation. So now this is the first mitigation. You do not enter. What you do now is you go to the 15-minute, the 1 hour, whatever it may be, and then you look for smaller time frame confirmation. So let's say the market does this thing, provides confirmation, and then you'll see a second mitigation, and then the market goes up. Right? So notice how there's two mitigations. Now, if we scale down, now let's say we didn't enter at this point. Let's say we waited for extra confirmation. Now what the market may do is it might come back down back to that last OB. You wait for an extra confirmation, the market goes up, comes back down, and then it goes up. Now you waited for a second mitigation. So basically every time you enter a trade, there should be two mitigations. Now, there's different ways of seeing this. So I used to think that when the market is coming back down for the second mitigation, it's simply hunting the stops. But then and then I started thinking logically, why would brokers be looking at my stop loss? Why would institutions, hedge fund, big banks with a lot of money, the big bad wolf, why would he, be looking and searching to hunt my $33 stop loss or my $100 stop loss, even if it's $1,000, which it's not, but even if it was $1,000, why would a broker or a hedge fund hunt a $1,000 stop loss? It doesn't make sense, right? So then I started to question myself again. Maybe it's not because of my stop is there. Maybe it's because that there's another order block there that needs to be mitigated, and that's why the market comes down for a second time and then takes off. So that's what it is. So now when I'm in a trade, all right, we buy right over here. This is the first mitigation. We get triggered, and then I see structure was broken. I do not move my stop loss to break even. The first qualification is we need to see the second mitigation. After the second mitigation, then that's the first step to moving your stop loss to break even, after the second mitigation. Now that's the first step. Having two mitigations on your zone. Now, what's the second step? The second step is the continuation of structure. So the continuation of structure, what is it? So there's a big difference between break of structure and continuation of structure. Although some traders like to call a continuation of structure a break of structure and a break of structure a change of character, it's very confusing, and it confused me, but it's all good at the end of the day. It's just terms and definitions. It's all subjective, so it's not a big deal. But a continuation of structure, in short term, a COS, is when the market is basically just continuing the structure. So if we're trending in an uptrend, the market continuously breaks the previous high and continues the structure. We're breaking previous highs and creating new highs. A break of structure is the opposite. If we're trending in an uptrend and the market creates a higher low that creates a higher high, and then from there we end up breaking that higher low that created the higher high, that is a break of structure. So it's just and then you can call this a CHOC or a flipping IOS, BOS, COS, KOS, LOS. You could use all the alphabets in the world. It doesn't matter. It's the definition remains the same. So yeah, so now after we get that second mitigation, what you want to see is a continuation of structure. What does a continuation of structure actually prove? Well, a continuation of structure proves that the trend itself is strong now, right? So if, once again, let's say there's a break of structure, right now we're not bearish. All we know is that the trend is in its beginning transitional stages of entering a bearish trend, but we're not bearish in itself. All we've seen is a break of structure. In order to be bearish, we need to see a continuation of structure. So now we have a BOS right here. After this BOS, we have a retracement, and then we have an impulsive move. This impulsive move broke the previous low, which continued the structure. Then it broke this previous low and made a new low. And then the market is going to come back up to create a retracement. And then this next low is going to be the next area that needs to be broken for a continuation of structure to happen. Price breaks it, another continuation of structure happens. So therefore, we know that the trend is strong after COS is happening. And most likely after each continuation of structure, the range is being moved. So first the range started from this point to this point. The market came back up, mitigated, not mitigated, sorry. It retraced maybe 80% of this impulsive move down, and then created a new range from this point to this point. And it's like a cycle. It happens over and over and over again. So after continuation of structure happens, what this means is that the market is now moving lower or higher in ranges, and that we are most likely going to continue to create a new range each and every single time. Now, in the beginning of a trend, the beginning of your trade, hopefully you're entering at a macro level so that way you can catch that big impulsive move. But at the beginning of your trade or of a trend, the continuation of structure is very important. In the beginning, this US is strong. Like everything else, an untested OB is strong, an untested level of supply is strong, an untested level of demand is strong. But once price action reaches a level of premium where it's no longer discounted and it doesn't make sense to buy anymore, then the continuation of structures will become weak. So we see that price is continuing structure, but logically, does it make sense for banks to buy at such a high price? No. Right? Logically, it doesn't make sense for them to buy at this high price because they know that they can bring the market down and sell, so capitalize on sell opportunities, and then buy at a cheaper price to later sell at a higher price. And that way, they're catching the best opportunities. They're catching it at the best time, and they're really capitalizing on money, right? Because their main goal is not just to make money. The bank's main goal is not just to make money. Although it is the goal, but it's sorry, let me re-explain this. I just confused myself. So making money, there's 50 different ways. But for the banks, there's shadow forms. Making money, right? So this is the main goal. Making money. What's the shadow form of making money? There's the aggressive style, so aggro. And then there's the conservative style, so CONS, conservative. So conservative and aggro, these are both shadow forms of money, making money, and how you can make money. What's the aggressive style? The aggressive style would be the banks just keep buying and buying and buying, no matter how premium prices or how discounted it is. They just keep buying and buying and buying. But what's the consequence of this? The consequence of buying at such a high price is eventually retailers as ourselves, and retailers, the ones that hear of Forex for the first day, deposit $50 on KOT Forex and then drop a one law. I'm just joking around, a stupid joke. But these traders, they're going to notice that the trend is just going up. So why don't I do the most common sense thing and buy? Right? And that's what's going to happen. And if the banks just keep buying and buying and buying and being aggressive, every retailer is going to catch the move. But if they look at things from more of a conservative approach, they take the conservative approach, and that equals to patience. Patien. I think I spelled this right. If I didn't spell this right, don't bully me. But nah, this is patience. All right. So when you take the patient approach, what does that mean? That means that you have something that others do not. And in society today, you could even search this up. Patience is not a common thing. Although common sense is also not even common nowadays, but patience, which used to be the most beloved trait to have as a man or a woman, and it used to be very common, it's not there anymore. And sadly, because of this, we lose a lot of money. A lot of your issues in trading has nothing to do with technicals. It's all about your psychological. That's if you have the technicals down, of course. So, oh, sorry about that. Something happened. So, the topic we're talking about is patience right now. So when the banks take the conservative approach, what they're mainly practicing is patience and delayed gratification. So at this point, instead of buying, they realize that it's a better opportunity to sell than buy. Why? Well, because if they sell, all these retailers that were going long, their liquidity is up for grab. And not only that, but then we also have retailers that are continuously looking for longs. They're continually looking for longs. They get lost in the trend, essentially, and that's what happens. So what the banks do is they take the conservative approach and they start selling. They sell all the way back down until price is discounted. But then the question comes, what's discounted? What's premium? This is where the Fibonacci comes in. So you want to take your fib and mark the low. So market started from the low of the impulsive move all the way up to the high. And I'll leave my Fibonacci levels in the description of the video, so make sure you scroll down and check that out later. But yeah, and then once price is discounted, price goes back up. So now that I went deep into the the history of the continuation of structure, and etc. and what. So we know why it's important, and we understand that in the beginning of a trend, the continuation of structure is very, very strong. But towards the end, it gets weak because the price is too premium to buy, and rather it makes more sense to sell. So eventually, even if there is a continuation of structure, price will do something like this. It'll impulse down, confusing so many traders that are following the higher high, higher low. But what they don't realize is the macro is too premium to buy. So now let's go over EURUSD. I'll go over this trade that, or actually we'll use USD JPY first and then EURUSD. So I'll go over USD JPY and explain how I used, actually we'll do EURUSD. We'll do EURUSD. I like this one better because there's a lot more examples for this. So we'll go over EURUSD and how I used, how I managed my trade, how I use trade management, the TraqFX way, per se. All right, so boom. My entry, it was, so there was a higher time frame institutional candle right here. We saw impulsive move up that continued structure, right? And then I waited for price to come into that a higher time frame zone and do its thing. From that point, I went straight down to the 1 minute and I monitored microstructure, right? Because micro and macro, they both co-align with each other. If macro is up but micro is down, this will happen. But if macro is up and micro is up, this will happen. So what we see is we have a high, and then there's a low, a lower high, and a lower low. Once this break of structure was present, I knew right away from the beginning that it's time to buy. But due to me not being on the charts at the time, I didn't buy. So that was, that was all good. So price action comes in here. Now, once we come in here, what's the first thing I'm looking for? Well, right away, we have a break of structure, right? So does that necessarily mean that microstructure is bullish? No. All it means is that we're in the beginning stages of microstructure transitioning to bullish. What am I looking for next? The continuation of structure, which is right over here. The low where the impulsive move started to the high where the impulsive move finished. That's your first range. This point to this point. Once price action entered this area of demand, which would have been a really clean entry, price action went up impulse and it continued structure. So once we saw that continuation of structure, what happened is the trend is now locked. It's locked and loaded. So you know how when you lock a door, it's not going to open, right? It's locked unless you unlock it. Once that continuation of structure was there, think of it as the door was locked. The trend is now bullish on the micro time frames. And now the range has went from this low to this high to this low to this high. And the market shall not break past this low because we created a new range. And that was all done by the continuation of structure. So then price action enters this area of demand. Boom, we enter. And same thing. Now I'm looking at microstructure one more time. We have a high, a low, a lower high, and then a lower low. Once again, I'm waiting for the BOS. We get that break of structure, right? Once we get that break of structure, where did the range start and where did the range finish? Well, the range started right over here. This low to this high. And then price action comes and this is where I actually entered. I'm not going to talk too much about my entry because I want to keep this video short and straight to the point. So price action comes into my entry point and moves up. What am I looking for? I'm looking for that continuation of structure. So someone now might ask, but Traq, if there's already been a continuation of structure over here, right? And the trend is locked and loaded, why do you have to wait for multiple continuations of structure? So this comes down to your entry. So notice that if I entered over here or if I entered over here, I wouldn't really need a continuation of structure anymore because I would have already had my continuation of structure. But because I didn't enter over here and these entries are now in the past, I had to look for more proof to confirm and validity, or to confirm the validity of this demand zone. So once price action entered this demand zone, I have no way of confirming whether price is actually going to use it to go up unless we have a continuation of structure. Otherwise, if there wasn't a continuation of structure, the most I could target is just over here, the next high, right? Because unless there's a continuation of structure, there's no proof that the market is going to surpass this high and go up and up and up and up and up. So now let's talk about how I manage this trade. So like I said before, the market will create an order block inside of the OB you entered. So this is the order block that I entered on, and then the market goes up, comes back down. Now, right over here, this is where the biggest mistake is created. You get entered, price goes up. Now, once it goes up, you get happy, you're excited, emotions are you know, they're catching up to your feelings, you know, emotions are being generated. You have that feeling in your stomach. Your wife is like, yo, book the plane ticket, let's get out of the house, let's go to the Bahamas, let's go to Pakistan, wherever, right? Wherever she wants to go. And then you move your stop loss to break even. You're like, you know what, I'm feeling good about this, but I'm also scared. I don't want to risk money anymore. Let me move my stop loss to break even. What happens? Price comes near it. You're like, oh, thank God. You know, thank God it saved me. And then boom, you get taken out. Now, once you get taken out, you are going to be tempted to revenge trade. Even though you didn't lose, you're still going to be pissed off because the time spent in the trade, and also you had high hopes for the trade, right? Now, how can you avoid this? So like I said in the beginning of the video, I do something out of the ordinary. I do something that I haven't seen much do. Well, actually, no, I can't say that. I take that back. I'm sure a lot of people do this. I'm not special or anything. I'm sure so many traders do this. I just haven't seen it done over YouTube or anyone explain it over YouTube. So what I do is when I'm tempted to minimize my risk, because obviously the first thing you want to do is the risk that you risk for your initial investment, you want to secure it. You no longer want to risk that same amount. So the goal is eventually to move your stop loss to break even. So when I saw this big impulsive move up, what I did was, okay, now I'm still risking about 1%, 9.4 pips, which is 1% of my account. Instead of risking 1%, or instead of moving my stop loss to break even, which will highly result in me getting stopped out at break even, I'll measure my zone of entry, which is this area, and I'll move my stop loss to 50% of the zone. Right over, hold on, let me mark this up. Right over here. Why is this more, why should I do this, and why should I not do move my stops to break even? Well, by doing this, not only are you minimizing your risk, so now you're only risking 0.50% to get the same reward of 9%. Although you're not going to be getting 18% because the lot size can't change. You're only going to be taking home 9%, or what your original risk was. So if I entered with my stop loss being here, and the risk to reward ratio is a 10-to-1, then no matter how much I minimize my stop loss, I will only take home 10-to-1. But what you're doing now is you're still keeping the same reward of 10%, but you're minimizing the risk to 0.50%. That way, that 1% risk is now 0.50. And that's a lot more that's a lot more calming, and you know, you could sit with that. Like, I'm not risking 1% anymore. I'm only risking 0.50. Oh, sorry about that. Family needed me. I had to go install an AC. But yeah, so where was I? Let's continue wherever we left off. So I've now reduced my risk from 1% to 0.50%. Now you might ask, well, Traq, what's the difference? What if you just like measured the 50% of this OB and entered at the 50%? What's the difference? Well, the difference between doing what I did and doing it right away, or waiting and then doing it right away, is this. The fact that we now have proof the market reacted off of our OB, this big OB right over here. The fact that now we have proof that the market reacted off of it provides me enough confidence that the market will now no longer break below this low. And what else did we talk about? We talked about the continuation of structure. So once there was this continuation of structure, which is right over here, boom, I have now proof, and I've identified that a new range has been created from this low to this high, right? And the market will not break below this low right over here. It will not break below this low because the trend is locked now. The trend is in lock. It's in position. There's no longer enough evidence there's no longer enough proof that the market is going to go down. So therefore, I minimize my risk to 50%, or I minimize my risk by 50%, and now I'm only risking 0.50. Now, when do you actually move your stop loss to break even? After the second mitigation is present, which we've seen right over here. The market comes down to for the second mitigation. And look, as I said before, the OB, there will be another OB that was created inside of your zone of interest. And right over here, we have that OB. So price action enters that institutional candle for a second mitigation. Once price enters that IC for a second mitigation, what you want to do is go down to the 1 minute and monitor this zone the same way you would monitor it as if you were entering. So treat it as if you were entering it. So we could see price action creates a high, a low, a lower high, and then a lower low. Once the market breaks past the last lower high that led price down into inside of our point of interest, and we break past it, that's when you can move your stop loss to break even. Right at this point is when you can move your stop to break even, because this right here, waiting for this break of structure, it provides me confirmation that now the market is done with this area. It's done with this point of interest. We're no longer going to be trading within this range anymore, and now the market is going to be trading within a new range from this low to this high. But what's the probability price is going to come all the way back down for a third mitigation? It doesn't make sense. It won't, right? Like as I mentioned before, institutions will not trade within an important point of interest for a long time. Once they see their point of interest, they will move right away. Once it's mitigated, it's gone. Think of it as gone. They're going to move on with their life, right? Because they don't, the point of the institution being an institution, what makes them unique is the fact that they trade on their own entity. Us, we're trading on the broker's entity technically, right? But what strategy are we using? The most common strategy, support, resistance, even supply and demand is becoming a very common strategy. So if everything's becoming common, the banks and the institutions, the hedge funds, they have to do something outside of the box to call themselves unique. And that's what it is, right? So once I explain, like I said before, once price action comes in to the second order block that was created inside of your entry point. So this is where we entered, and as I said, the market will create an order block inside where you entered, and then the market will come back down to mitigate that OB. Once that happens, all you want to do is wait for a break of structure of the micro time frames. Once there's a break of structure on the micro time frames, you have confirmation that price is now going to go up, and we're done with this area. We're no longer going to consolidate within this range anymore. There's no more purpose left. And from that point moving forward, the market can now approach new highs and new levels of supply and demand, and etc. And that's exactly what happened right here. We had our entry filled, and then take profit was hit just about a few hours ago, I think 2 to 3 hours ago. I'll also show y'all the Discord signal that I sent out of this trade. The signal was right over here, as you can see. Entry. Now my take profit was essentially here, but I moved it. I updated everyone that that's no longer the TP. So yeah, EURUSD signal alert, buy limit. Right over here is where I send out all my setups. So it's very easy, and then right over here is where I send out all the scalping setups. And this is the Discord. It's a very, very nice, well designed by your boy himself. So yeah, but now that covered a small portion, which is when should you move your stop loss to break even. Now the question might come, when should I partial? So this question has a very complicated answer, because partialing is initially subjective, right? My partial could be your take profit. My partial could be your trailing your stop, right? My partial could be your like getting out. So you get what I mean? Partialing, it depends on the trader himself. Do I partial? Nowadays, I haven't been partialing recently. I let my trades run to full. But when I'm scalping, I 100% partial, and I'll explain why. So with partialing, with taking partial profits, what you're basically doing is you're paying yourself while you're giving yourself, you're paying yourself after you take the risk out of your investment. So once your investment is risk-free, you start to pay yourself slowly. Although you're paying yourself early, you're giving yourself an early paycheck, you're also cutting out a big portion of what your big paycheck would have been if you would have never partialed. But by partialing, you're also protecting yourself, you're protecting your account from future losses, or from very dumb, like, 1% losses, 0.50% losses, 0.25% losses. Because what you're doing is you're basically partialing. Let's say you're up 5%. You take 2.5% off, move your stop loss to break even, and you let the rest run. The benefit of doing this is you took 2.5% off, so even if the market does take you out, you go home with the profit. Also, trading becomes so much more relaxed. In my language, we say it becomes sukoon. So you have this sense of sukoon, this relaxation that I have 2.5% that I've already taken. My stop's at break even. I don't really have to manage this trade anymore. This can either run for a 50 to 1 or a 20 to 1 or a 1 to 1, or I'll get out at break even at a 2.5% winner. So that's the benefit of partialing. Now, what's the con of partialing? Well, the cons of partialing is, let's say I'm in a trade that's running 1 to 5, right? And the end goal to take profit is a 1 to 10. If I take 50% of my profit at 1 to 5, That means I took about 2.5%. So what's 10% minus 2.5? 8.5, right? If I'm correct. Let me just double check. 7.5. 7.5, my fault. So 7.5. So now it's only 7.5. So although you still took a 1 to 10 RR trade, you really only took a 1.7 to 7.5. And in the long run, you'll notice that this will eat up a lot of your RR. But as long as you stay consistent and persistent with your trading plans and rules, you'll still come out a winner at the end. But you won't be taking out the 100% profit that you won't be coming out with the big paycheck. You'll be coming out with 70% of your paycheck, 80% of your paycheck, 90% of your paycheck at times. But remember, with partialing, you also have to be consistent, because if you continue to partial, let's say I take partial profits here and the market goes up, and I take partial profits here, and that's 50% gone. I took, let's say it's a 1 to 10, I took 5%. That's 1 to 5 right there. I took it. And then the market goes down and stops me out. And then I lose the next 5 trades. I'm back to break even, right? And then let's assume I continue to trade. I'm partialing. I take partials. I've moved my stop loss to break even. And then boom, price action comes back down, stops me out, and I only took 2.5% home. Eventually, those small partials, which is only like adding up to 2.5% profits, 3.5% profits, 4.5% profits at the max, is gonna like minimize how much you're taking home, and it's gonna be easier for you to lose, and your account will not grow as fast as it normally would. Now, for example, if I took partials along the way with EURUSD, this we did not take any partials at all. It was a straight 1 to 10, 10% was taken. But if I took partials along the way at every single lower high, or every single higher low, whatever it would have been, right? Let's say I took 10% off here, and then 10% off here, 10% off here, 10% off here. I'm really only taking home 50% of what I should have taken home. But if I didn't take any partials at all, I would have taken home 10%, and it would take me 10 trades to lose in order to lose all the money that I made. And that would, you'd have to really mess up in order to lose 10 trades in a row, or you have bad luck, which is normal. Now, I don't partial, and that's for that specific reason. When I scalp, I do partial. The reason I partial when I scalp is because scalping is moving really quickly. The market's 1 second is going up, the next second is going down, right? Delete this. So when you're scalping, let's assume XAU USD, I entered at this sell point. This is my area, and I'm in for a sell. Once the market goes down my way, it can easily reverse right away because it's such a small time frame and things are happening quickly. So with partialing, it's like once you see the break of structure and you're in and you're in profit, you might want to take partial, move your stop to break even, and get out right away, right? The reason with this is because since the market is moving really quickly, it's going up and down. That means there's inconsistency, and you can't really trust it. It's not a reliable source because the market can easily reverse. The same way, if we have a 4-hour order block, and then we compare it to a 1 minute order block, obviously the 4-hour order block is going to be much more stronger than the 1 minute. So although on the 1 minute there may be clean fractal setups, they may not provide you with the by long I don't mean buy, but with the long held opportunities that the 4-hour will provide you. For example, if the market enters a 4-hour point of interest, you might notice that the 4-hour is very reliable. It'll go up for a long period of time, and you'll be able to hold this and swing it. But if the market comes to a 1 minute point of interest, because it's such a small time frame, you really only want to set targets at 1 minute highs and 1 minute lows, max at a 1 minute macro high, and then you want to get out. So when do you partial? So with partials, I don't have an example, or I'll try to find an example. Right now we'll use a theoretical example. With partialing, when you're scalping, is generally whenever the trade is going your direction. So let's assume the market is in a downtrend and I'm looking to buy, and then price does a break of structure, comes in here, and then I enter because there's confirmation. Once I enter, my first area where I will be partialing is the next high right over here. Once price action breaks above this point, stop loss should be moved to break even, because remember, we're scalping, so we want to protect our position right away. So stop loss is moved to break even, and your first partial is taken. And then what you want to do is you want to take partials along the way of all the lower highs that were previously created. So if price created a lower high here, a lower high over here, and a lower high over here, you would want to take partials along the way. Now that's one way of partialing. You take partial at every single lower high. If you're taking partials at every single lower high, you generally want to be taking 10% off here, 20% off here, 30, 40, and etc. But if you want to do the TraqFX way, or matter of fact, this isn't the TraqFX way. I learned this off of mgmt, so shout out to him. I was watching one of his videos, and in his videos, I noticed that when he takes partials, it may be 50%, and then he just lets the rest run. It doesn't matter if it hits him at break even, or it goes all the way to 60 to 1 RR, whatever it may be. He just lets it run. So that's another way you can do it. And shout out to him for making me aware of the fact that that's a good way to take profits, to partial. So once price action reaches your first partial, which should always be the next high, that should always be your next high, you could take 50% off and literally let the rest run. Let it go to Kumbaya, let it go to wherever, New York City, anywhere. Just let the trade do its thing and let the market be the market. Now, obviously, you also want to have in mind where you really want to get out, like where the higher time frame is, because eventually the 1 minute will it will lead up to the 1 hour, going to the 2 hour, going to the 3 hour, going to the 4 hour, to a big crash. So it all starts with a 1 minute. So make sure you do take profit at a level of a higher time frame. So eventually, when the market does run, like let's say 50 to 1 RR or 1 to 50 RR, that makes a lot more sense. You want to get out. You want to get out at that 1 hour level of supply, because once the higher time frame takes over and the higher time frame narrative is in, it doesn't matter what the 1 minute did 20 minutes ago. It will sell off, because the higher time frame is much more superior than the smaller time frame. So that's how I partial. You can do the 50% way, where you take 50% off as soon as the first high is taken out, or and then let the rest run until you're satisfied. Or what you could do is you could take partials along the way. And yeah, now also be free with it. You know, trade your personality. Be free with the way you partial and move your stops to break even. Obviously, don't make emotional decisions and emotional choices like, oh, because the market is at 4 to 1 RR, I'll move my stop to break even. That's not really a logical reason, is it? Because with this way of thinking, we're basically saying that, oh, since the market is 4% in profit, that means that the market is not going to come back down to stop me at break even. It doesn't make sense, right? What's happening is you look at the 4% profit, you look at the 1 to 4, and it gets addicting. It's very satisfying to see that I'm up 1 to 4. And then also to gratify the fact that you can show your friends that, look, I'm up 1 to 4, and you don't want to lose anymore. Also, who wants to lose money? So at the end of the day, it's a bit of your ego, it's a bit of fear, it's a bit of a bunch of emotions. So when you move your stop loss to break even just because of a number, just because you've reached this level of profit, it's incorrect. I believe that this is not valid. The correct way to do it is the way I explained it before. Once price action does a second mitigation and then goes up and there's a continuation of structure and a break of structure, that's when you can move your stop loss to break even, because the range is now changing. We had a range from here to here, and notice how the retracements, they never ever go below where the low was created. We create a new low, market hits a new high, and it comes back to around near the same low but does not quite break below it. It always just closes right above it, because it's a range, it's a protected low, and the market cannot break past these protected lows. So once there's a new range is being created, eventually the market will have no business trading within this area, and rather is going to have more higher objectives to take out levels of supply that reside on the daily, the weekly, and etc. Now, trailing your stop, this is something that I haven't done in a long time, but it can be very, very effective, and I believe that this is one of the best ways to secure positions and secure profits. So let's assume you're in a position on the 15-minute time frame, right over here on the 15-minute. The trade is going your way, you're in a buy, you get triggered in, and the trade is going your way. You move your stop loss to break even. Now, have you ever noticed, I'm sure this has happened to a lot of us, especially me, that when the trade is going your direction, it's so volatile, eventually it'll have this big crash, like a huge crash. Now, why does this happen? This goes all the way back to discounted and premium. When something is too premium, the market will not buy, and if something is too discounted, the market will not sell. So for the traders who like to hold their trades for long periods of time, but they also don't want to overdo it, they don't want to overhype it, like they don't want to take partials, they want to make sure they maximize their profits, what they can do is they can trail their stops. So Once the trade is going your way, let's assume you bought at this low and the market is now going up. After every single high that's broken and every single higher low that's created, you would want to trail your stop up by 50%. So for example, we have this continuation of structure. You would want to get your Fibonacci out and measure from the low to the high where the continuation of structure happened and set your stop loss at 50%. And then once again, when the market creates another higher low to a higher high, do the same thing. Get your Fibonacci out, measure from the low to the high, and set your stop loss at 50%. And then do the same thing over and over and over again until eventually where you get stopped out, because it will happen. Now, why is trailing your stop a lot more effective than taking partials? So taking partials and trailing your stop, they're good in their own ways. It's not one is better than the other and the second is not better. It kind of depends. Actually, I'll take that statement back. One is better than the other according to your trading style. So in this case, why would it be more effective? Well, it's because you're not actually partialing. So you're taking whatever the market is giving you. So let's assume the market goes all the way up to this point and I move my stop to 50% of this impulsive move. From this point all the way to where I entered, I'm assuming this would be a 6 to 1, 7 to 1. Yeah, 7 to 1 RR. But if I partialed along the way at this high, at this lower high, at this lower high, at this lower high, eventually when the market reaches all the way up to here, I'm only taking home about 1 to 4, 1 to 5, right? So although there's more pips in partialing, there's less percentage, but in trailing your stop, there's a lot more percentage and less pips. Because why do I say less pips? Well, because the trade would be closed right here. Whenever the market reaches that 50% and it breaks past it, the trade is closed. And you're coming out with less pips, but more percent. So that means that the pips to percent correlation in reward is not actually a positive correlation. That means that there could be low pips, but a high percent. There could be high pips, but a low percent in gain. Right? So percentages is not always important. It's more, or sorry, not percentage. Pips are not always important. It's more about percentages. I could be in a trade that has a 10 pip take profit and a 1 pip stop. That's a 10 to 1. And with the right loss size, with the right risk management, I would be making a lot of money. Alhamdulillah, if that goes my way, obviously. But anyways, that's how I would trail my stop. So that's generally how I do trade management. The last and final topic is take profit. So with take profits, it depends on where you entered. So for example, I entered this trade on the 20-minute time frame, if I'm not mistaken. Yes, it was the 20-minute time frame where I sent the signal out. Let's go all the way back right here. When I sent the signal out, where was I targeting? I was targeting the 1 hour high. Number one, why was I targeting the 1 hour high? The reason I was targeting the 1 hour high was because of the structure. We could see that after every single higher low that's created, we end up taking the next higher high out and creating another one. So the general direction of the market right now, the momentum of the market, is that we're following a pattern that's creating higher highs and higher lows. And at this point, we respected a major higher low, a macro 1 hour higher low. And then after that, price action on the 1 minute time frame was respecting the smaller time frame demand zones, which is a perfect example of order flow being respected. So once I saw that, I knew that most likely if we're respecting the lower time frame and the higher time frame this much, it only means that we're making urges to go higher, that the market desires to create a new high, right? And over here, obviously, if you guys watched my other video about swing point highs and swing point low liquidity, we would know that there's a ton of liquidity resting here. All those traders are looking to go long. They set buy stops above. So what happens? Price is going to go up, obviously, reach that area of liquidity slowly but surely. Boom. What happens? All those traders who set buy stops above, they get triggered in. They're expecting the market to go up, but then the market goes down to reverse. It reverses and stops them out to grab all the money that resides over here. Now, I did this through back testing, so it was very quick. But if in reality, this took a lot of time and patience. I was holding this trade for about 7 days, including the weekend. If I don't include the weekend, it was probably 5 to 4 days. But 7 days including the weekend, and that requires a lot of patience. So remember, the market maker is not always looking to go long and short at certain times. Sometimes you just got to be patient. Sometimes you just have to wait for the perfect opportunity. And yes, there is a perfect opportunity to enter. There's multiple perfect opportunities and there's a non-perfect opportunity. You have to differentiate from the two. But anyways, I hope you guys found this video helpful. If you did, please leave a like, comment, and subscribe for future videos. Put that notification bell on so that you guys are notified right away for these bangers. And inshallah, I'll see you on the next one. Peace out.